Have you ever avoided a stock because it had a very high PE ratio only to see it double or triple in price? At the same time, you bought a stock because the PE ratio looked very low and then the stock price dropped another 50%. Well, if you experience that, you are not alone. This is a very, very common mistake that amateurs make. Many amateurs, they use PE ratio as a way to decide whether a stock is expensive or cheap and to decide whether it's a good time to buy or sell. Now, I used to make this mistake myself many, many years ago. So in this video, I'd like to tell you the truth about PE ratios. Now, if you take any investing or finance course, one of the first things you probably learn is the PE ratio or the price earnings ratio, which is a ratio where you divide the current share price by the earnings per share. So for example, if the stock or the business is earning, let's say $1 a share. So every share you own earns $1 in profit, and the share price is selling at say $20 right now. So if you take $20, the price per share, divide by earnings per share, get a PE ratio of 20 times, which basically tells you that for every $1 in earnings, you're paying 20 times to buy that $1 of earnings. So theoretically, if the earnings don't grow, you get $1 every year. It takes 20 years to break even. And in basic finance school, they tell you that low PE means the stock is cheap, high PE means the stock is expensive. So you want to avoid the high PE stocks and buy the low PE stocks. Now, in reality, this doesn't work out very well for the investor. And the reason is because PE ratio is oftentimes a very, very misleading and a very, very inaccurate way to measure whether a stock is expensive or cheap. Now, don't get me wrong, PE ratio works sometimes, but it doesn't work all the time. And I heard this very interesting saying that says that, trying to use PE ratio to determine the value of a stock is like trying to guess the weight of a person by looking at their shadow. Sometimes a skinny person could have a big shadow and a fat person could have a skinny shadow depending on the angle and the lighting and all that. So the same thing goes with PE ratios. And sometimes a stock that has a high PE ratio could actually be very cheap. I'll show you an example in a while. And a stock with a low PE ratio could actually be very expensive. Again, why? Because PE ratio by itself can be very, very misleading at times. So let me show you a few live examples of why it's not always a good idea to avoid a stock just because, the PE is so high, or to buy a stock because just the PE is so low, right? You can't just look at it by itself. Now, look at Apple, for example. About 12 years ago, Apple's PE ratio, this is the PE ratio, was at 33 times. Now, many people think that, 33 times is too expensive, right? I'm not going to buy Apple. But if you bought Apple at that time, it was selling at about $10. This is adjusted for share splits. And 12 years later, it's at $183, right? So that's 2,500% return over 12 years, right? That's, if you think about it, that's about over 100% return a year buying a stock with a 33 PE ratio. Now you may think, but Adam, that's a very long time. That's like 12 years. No, look at the short term, right? Just about less than 3 years ago, right? Apple's PE ratio was 40 times earnings. And again, some people say it's too expensive. But if you bought it at 40 times earnings, Apple's share price at that point of time, today you'd be up 52%. Now, some of you may say you can't use Apple. Apple's a cult stock. It's being pumped up by all these hype, right? Or Apple's a tech stock. It's not counted. Okay, fine. Let's look at a very boring company that is non-tech, that's not hyped up, right? That doesn't have a lot of cult followers. Let's look at McDonald's, one of the most boring stocks you can find, right? Same thing. Less than 3 years ago, McDonald's was a PE ratio at the time. The PE ratio was 35 times. Again, to most people, they think it's expensive, right? But if you bought McDonald's at 35 times earnings, less than 3 years ago, today, you are up 44% return. Let's look at another very boring non-tech stock, Hershey's. All right, Hershey's, same thing. Less than 3 years ago, the PE ratio was 29 times earnings. Okay, if you bought it at 29 times earnings, share price is now up 85%. In fact, it went up to 30 times earnings. Even if you bought it at 30 times earnings, you'd be making a pretty good return. Conversely, a low PE stock may not be always a cheap good deal, right? Like again, about 2.5 years ago, if you bought GSK, which is a pharmaceutical company, the PE ratio was 10 times earnings. You say, only 10 times earnings is so cheap, it's a good deal, right? If you bought it, at 10 times earnings, after 2.5 years, you're down 10%. So in deciding what stock to buy and when to buy, you can't look at PE ratio by itself. By itself, it is pretty meaningless, right? Now, the trouble with PE ratio is that it doesn't take into account the quality of the business. Remember, every stock you buy, there's an underlying business. You're becoming the part owner of the business. So the first thing is to make sure it's a high quality business. Number two, PE ratio doesn't take into account the growth of the earnings of the business. So let me ask you a question. Let's imagine that you've got two stocks. Stock A with a PE ratio of 10 times earnings, stock B with a PE ratio of 20 times earnings. Now, which stock is cheaper? I'm here to tell you that actually stock A is more expensive and stock B is cheaper. Now you may be wondering, how can that be? That doesn't make sense. Well, it's because I didn't give you the other piece of information that you need, which is the earnings growth. Now, I'm going to tell you that stock A, the earnings, the E, is growing at zero. There's zero earnings growth, which means the earnings is the same every single year. Yeah. But for stock B, the earnings are growing at, let's say, 50% a year. All right. So now clearly stock B is cheaper, stock A is more expensive. So why? Let me kind of explain. Okay. So let's look at stock A again. Now, let's imagine that stock A, the share price is $10 per share, okay? And what's the earnings per share? The earnings per share is $1, right? $1 earnings per share. So again, if you take the price per share, divide by earnings per share, 10 divided by 1, you get 10 times earnings, right? Okay. So if you buy this stock, theoretically, every year you get $1 in earnings per share, right? So in year one, let's call this year one, okay, you get $1 earnings per share. Okay, in year two, you get $1 earnings per share, and so on and so forth. Okay, so how many years does it take for you to get back your $10 that you paid? Right, it'll take you altogether 10 years to get your money back. So the break-even period is 10 years for stock A. Yeah. Now let's look at stock B. Now for stock B, let's assume that same thing. The earnings per share of stock B is also $1. But for stock B, you're paying $20 to buy the stock. Okay? So if you take $20 divided by $1 earnings per share, you get 20 times earnings. So on the surface, it looks like this is more expensive, but the earnings are growing at 50%, which means that, again, let's take a look at stock B, which means that in year one, right, in the first year, you get $1 in earnings per share. But in year two, what do you get? You get 50% more because it's growing at 50%, right? So you get $1.50 in year two, and then it grows 50%. Year three, you get, let's see, $2.25. Year four, you get increased by 50%, you get $3.37. Then year two, year three, year four, year five, this becomes $5. And year six, this becomes $7.50. Okay, now if you add this up, if you add $1 plus $1.50 plus $2.25, now you add this up, you will get your $20 back, which you paid for the stock, for the share, right? So in stock B, how many years did it take to break even? It's 1, 2, 3, 4, 5, 6. 6 years to get your money back, whereas for stock A, it took 10 years to get your money back. You see what I'm saying? So again, the most important lesson to understand is that PE ratio by itself is meaningless unless you know what is the E, the growth of the earnings, right? So a stock with a low PE could actually be expensive if the earnings are not growing or the earnings are declining. Where stock B with a higher PE could be cheap if the earnings are growing very, very fast. So to an amateur investor, GSK looked very cheap with only a PE ratio of 10 times earnings 2.5 years ago. But to the smart investor, they know that GSK is not cheap even with a low PE, because they can see that the earnings are not growing. In fact, over the last many years, the revenue has been declining, the profits have been going down, the cash flow has been going down, it's been having negative growth. On the other hand, Hershey's looked expensive with a 29 PE ratio, but it's a higher quality business. So the fact that Hershey's has got double-digit growth, as you can see from the revenue as well as the net income, right? Revenue growth, net income growth, and cash flow operations growth, it grows double digits. So because of that, it justifies its high PE ratio. So the first lesson to learn again is that PE ratio by itself may not be very useful because it doesn't take into account the quality of the business and the growth of the earnings. And that's why many years ago, one of the things that I've learned from Warren Buffett is that it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. So what does that mean? So what he's saying is that it's better to buy a high quality business that is not cheap, but is fairly priced, maybe slightly at a premium, than to buy an average company or lousy company that looks very, very cheap. And that's a very common mistake I see many amateurs make. I have a lot of students who say to me, Adam, this stock looks so cheap, the PE is so low, the price drops so much, but I said it's a low quality business, so I don't care how cheap it looks. If it's a low quality business, cheap crap is still crap. And that's why at the Piranha Profits Value Momentum Investing course, what I teach my students is that before you buy a stock, remember you're buying a business. And before you buy or invest in a business, it's got to pass my 7-step criteria. And of the 7 steps, the first 5 steps is to qualify that it must first be a high quality, excellent business with a wide economic moat, consistent growth in revenue, free cash flow, high return on capital, low debt, right? It's got to pass all those steps first. Then we look at the valuation. Is it selling at a reasonable price? It doesn't have to be cheap as long as it's a reasonable price. We'll invest in that stock. So once again, before you look at the PE, first look at the business. Is it a high quality business? It's kind of like, buying a car, right? You don't just look at the price. First look at the car. What car are you getting? Are you getting a high quality car with a strong engine, or are you getting a broken down car that can't move very fast, right? So the first thing is to make sure that we are buying only the high quality cars. And so that's why I keep saying, as an investor, I only invest in the top 1% of companies in the world that are the Lamborghinis and Ferraris of the world, if you will, right? Then I look at the valuation, okay? And again, a PE of 30 may not be very expensive if the earnings justify that PE ratio. Now, some of you may be saying, but Adam, how about could we find a Lamborghini, a high quality business selling at a PE of 10? Could that happen? Yes, it happens once in a while. Very rarely, but it happens once in a while. And when you see that big mispricing, you gotta buy like crazy. And by the way, last year, there were companies in this category. Example, Meta, also known as Facebook. If you remember, last year, Meta was one of the most hated stocks in the market. Right? A lot of people were shitting on Meta. They said, it's over, Mark Zuckerberg has lost it, and Meta's share price dropped 75%. And if you guys recall, I was the one that was saying that, keep holding Meta and buy more. So I was averaging down, because when I look at the underlying business, Meta was a great business, right? It's still a great business. So to me, Meta is like a Lamborghini, it's a Ferrari, that last year temporarily it was selling, I think almost went as low as 8 or 12 times PE ratio if you take out the cash of the business. So this was an example of Meta. And although this year Meta has already gone up so much, I think more than 100% return so far this year, but Meta to me is still very cheap. All right, if you look at the forward PE ratio x the cash, it's still about 15 times earnings. And for Meta's future growth, it's still very cheap. Now, again, this is my opinion. Please don't buy Meta because of what I said. Disclaimer, I own Meta shares and I continue to hold them even though it's gone up quite a bit because I still think that it is relatively quite cheap. All right, now let's move on to the next part. The other reason why PE ratio can be very misleading is because remember that PE ratio comes from the share price divided by the earnings per share, right? Now, where does earnings come from? Earnings comes from the net income after tax from the company's income statement. Now, the trouble is the net income cannot always be trusted. In fact, many times the net income of a company is an accounting number that can often be distorted. All right. How is it distorted? Well, it can be distorted by creative accounting based on how they provision for depreciation, amortization. It can also be distorted because of non-recurring items. That means expenses or revenue that happen once, but it doesn't recur in the business, right? Or it's also distorted by non-operating income and non-operating expenses. Now, what does this mean, right? So let me explain. Non-operating income and non-operating expenses are income that's earned or expenses that are not related to the company's core business. So let me give you an example, right? If you look at Salesforce, one of the companies that I own is Salesforce, a software company, right? Now, the last few years, if you look at the net income, it looks very low, and that makes the PE ratio look very big. But you can't trust the PE ratio because the net income was distorted by non-operating expenses, which are expenses that are one time, they don't recur in the future, and they are caused by things that are not related to the business operations. So for Salesforce, the main non-operating expenses was restructuring costs, because Salesforce, they did a lot of mergers and acquisitions. So when you acquire a company, there's a lot of expenses for lawyers and for all kinds of things, right? So that created a big expense in the income statement, lowered the profits, and made the PE ratio look very big and distorted. So people looked at a high PE and they thought Salesforce is expensive. No, Salesforce is cheap because you have to remove the non-operating expenses. All right. So let me give you the actual example over here. This is Salesforce, okay? Now, if you take a look at Salesforce, their revenue has been growing consistently, right? 13 billion, 17, 21, 26, 31, 32 billion, right? So they're growing revenue very nicely, all right? But if you look at the net income, the net profit that goes into the earnings per share, right? It's 1.1 billion, then it drops to 126 million, right? Then 4 billion, 1.4 billion, 208 million, and the last 12 months is only 379 million. So if you simply take this net profit and divide by the number of shares to get the earnings per share, right? You take the share price, divide by the earnings per share, it will make the PE ratio look very big. So you can see that if you take a look at the PE ratio of Salesforce, ticker symbol CRM, what's the PE ratio right now? Is 551. So when I told people that Salesforce is cheap and I was buying Salesforce, they said, "Are you crazy? Are you nuts? It's 500 PE, Adam, it's so expensive." I said, "No, it's cheap." Right? Now, in full disclaimer, you can see my portfolio. That's right, Salesforce, that's my 5th biggest position, right? Amazon, Meta, Microsoft, Alphabet. Salesforce is my 5th biggest position. And I'm up about, well, I'm slightly up. My average price is 181 and right now it's 207. So I'm slightly above the average price. But let me explain right now why Salesforce is actually cheap and the PE ratio is totally bullshit. It gives you a bullshit idea about the true value of Salesforce, all right? So let's take a closer look at the income statement, right? Now again, what's the revenue? The revenue is $32 billion. But why is the net profit only $379 million? Now remember that this is a software company. If you look at most software companies like Microsoft and other software companies, what's the net profit margin? The net profit margin should be at least about 20%, right? Correct? Right? So if you take 32 billion times 20%, that's about 6.4 billion, which means that Salesforce, they should be making about 6.4 billion in profit, right? By right, as a software company, and they are the market leader, right? So at least 6.4 billion in profit. But why is their profit only 300 million? Because it has been distorted by non-operating expenses and non-recurring items. And let me give you a few examples over here. So Now, first of all, you take revenue minus your cost of goods sold minus your operating expenses, you get what we call operating income. So operating income is the income that is directly based on the business performance, okay? But what happens is you got all these non-operating expenses, of which one of the big ones is restructuring costs. Restructuring, mergers, and restructuring charges. So you can see because of that, it deducted a big chunk from there, right? As well as loss on sale of investment, which again is a non-recurring item. So this profit you see is what we call not normal, right? It's a distorted profit because of these one-time charges. So as an analyst, as someone who values a business, you have to calculate the normalized earnings by adding back these non-operating expenses or deducting non-operating income. So in other words, if you take this 379 over here, which is their profit, you have to add back 1.5 billion, which is their restructuring charges, and you add back this loss on sale of investment, you get a more normalized net profit of 2.3 billion. Now, if you take $2.3 billion divided by 32 billion, which is the revenue, that will give you a net profit margin of only 7%, which is too low for a software company. Remember, a software company should have net profit margin of at least 20 to 25%. So where did all these expenses go? The culprit is over here, right? You can see under selling, general and admin expenses and R&D, there's a huge chunk of these expenses that are what I call bullshit expenses, right? What do I mean? Now, a big chunk of those expenses are not actually cash expenses. They are amortization of intangible assets as a result of merger and acquisition. Okay, what the hell does that mean? So basically, Salesforce, the last few years, they spend billions of dollars to acquire other companies and they pay for their goodwill and all that bullshit, right? And what they do is they then expense all these goodwill through amortization over the next few years. So this creates a lot of expenses that lowers the net profit. But this is only temporary because once they expense and amortize all this shit, if you will, then a lot of this disappears. And the profit margin will go to about 20%, which is their normalized profit margin. And that's why when I analyze a business, when I value a business, I don't look at net profit because net profit is an accounting number that is very often distorted by all these intangible amortization, depreciation, right? So the true way to value a company is to look at the free cash flow. Is the actual cash that the company generates minus the capital expenditures, okay? So what's more important is to look at the cash flow statement and to look at the free cash flow. So you look at the last 12 months, what is the free cash flow of Salesforce? Well, you take the cash from operations, which is 7.9 billion of cash they generate, right? Minus the capital expenditure of 862 million gives you a free cash flow of 7 billion. Now we are talking. So 7 billion of free cash flow they're generating is about roughly about, I think, let me just check, right? 7 divided by 32, it's about 21% net profit margin, or rather free cash flow margin, which is their actual earning ability, right? So once I know this, I can then value the business. Remember, the value of a business is the present value of all its future cash flow. So you have to, you have to calculate how much cash you'll generate in the future and discount to present value. We call this the discounted free cash flow method. Now, I don't like to assume the company will last forever. I don't take a terminal value. So I'll just project the free cash flow for 20 years and discount it to present value. And I use our intrinsic value calculator to do that. So this is the Piranha Profits intrinsic value calculator. That's our proprietary calculator that all our students get when you enroll in the Wealth Academy Masterclass or the value investment course that we teach, right? So over here, you can see that I put in the free cash flow, right? This should be free cash flow. Yep. The free cash flow is $7 billion, which you saw just now. The total debt of the company is $9 billion, and the total cash and investments $13.9 billion, right? And we project it for the next 20 years, right? So what growth rate do we use? Well, if you look at different websites, if you go to Finviz, for example, let's go to Finviz. You can see on Finviz, the projected growth rate is 24% growth rate, okay? And if you go to other websites, they give you different growth rates. Like on Guru Focus, the growth rate for Salesforce, is it Salesforce? Yep, Salesforce, the projected growth rate is 18%, right? So you've got different projections from different websites. So what I do is I take an average, right? You can see 24% growth from Finviz, 24% from Capital IQ, 18% from Guru Focus, 19% from Zack. So if you take an average, the average growth of Salesforce for the next 5 years is 21%, okay? Now, I'm going to be very conservative and take the lowest growth rate of 18.36%. There we are, 18.36%. And for the following 5 years, I'm going to cap it at 15% growth, which is the normal thing I do. And the last 10 years, I just put a 4% growth rate, which is just GDP plus 1%, right? 977 million shares outstanding, 7% discount rate. Boom! What's the intrinsic value? The intrinsic value is $277. So now I know that Salesforce, based on its earning power, its ability to generate free cash flow, is worth $277. And what's the share price right now? The share price right now is $209. So is that cheap or expensive, right? So at $209, you can see that it's currently 24% undervalued. So Salesforce is cheap. So you can see how PE ratio can be so misleading, right? From the PE, you say, oh, 500 is expensive. It's not, because the earnings is all distorted, right? By all this bullshit accounting. If you strip it out, use free cash flow, do a DCF formula, you know the true value of a company. So that's the secret to my formula, and that's how I've been beating the market for so many years, buying great companies at huge discounts. So of course, you want to learn more, join our Value Momentum Investing class, join our community, our masterclass coming up soon, and learn this very important skill. So you know how to buy great companies when they're cheap and how to sell them when they're expensive. Now again, like I said, when it gets too expensive, like Nvidia, it's good to take some profits off the table. Hope you learned something from this video, and I'll see you guys in the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.